Welcome to RTR Supports Limited. Some non-resident UK companies never face bank freezes, EMI blocks, or sudden payment suspensions, even in industries that banks classify as high risk. It's not luck, it's not connections, and it's not paperwork alone. It's operational setup. In this video, I'll show you how banks and payment platforms assess operational structure in 2026, and how to design yours so your company stays stable, trusted, and bankable. Paperwork gets you approved. Operations keep you approved. Most founders focus heavily on incorporation documents, KYC files, and compliance forms. And yes, those are essential for onboarding. But once your account is live, banks move from document review to behavioral monitoring. They don't just assess what you submitted, they assess how your business actually functions. And that is where operational design becomes critical. When banks talk about operational risk, they're talking about control. Who makes decisions? How does money move? Are transactions predictable? Is there oversight? Operational risk increases when activity looks inconsistent, unclear, or reactive. Even if your compliance is technically perfect, messy internal processes create red flags. From a bank's perspective, unpredictability equals risk. And risk leads to monitoring, reviews, or restrictions. Even small companies need clearly defined roles. Director responsibilities, operational responsibilities, financial control responsibilities. One person can wear multiple hats, especially in early-stage businesses. But responsibilities must be structured and clearly understood. Banks want to see that decisions are deliberate, not improvised. If nobody can clearly explain who approves payments, who oversees financial records, or who manages operational changes, that signals weak internal control. And weak control creates concern. You should be able to explain your money flow in writing. Where does money come from? How is it used? Why does it move where it moves? Money in, money used, money out. This sounds simple, but many founders rely on verbal explanations instead of structured documentation. When a bank reviews your account, clarity matters. If your flow makes sense on paper, it builds trust. If it needs lengthy explanations, it raises questions. In 2026, behavioral monitoring is automated. Algorithms flag sudden spikes, unusual counterparties, rapid changes in volume. Banks prefer gradual, predictable growth. Consistency is more important than speed. Sudden, unexplained increases in activity trigger reviews, even if the transactions are legitimate. Predictable patterns reduce friction. Unpredictable behavior increases scrutiny. Growth is positive. Unstructured growth is risky. Even if you use accountants, you must understand your numbers at a high level. You should know your monthly inflow range, your main expense categories, your average payment size. During a review, "Ask my accountant" is not a strong answer. Banks want to see that directors understand their own operations. Ownership includes oversight. Control includes awareness. When you know your numbers, you demonstrate stability. Frequent small changes look like instability. Changing payment providers every few months. Constantly adjusting business models. Shifting operational structures without documentation. From the inside, this may feel like optimization. From the outside, it looks unpredictable. Banks trust boring operations, stable providers, clear plans, deliberate updates, not reactive pivots. Controlled change signals maturity. Constant change signals risk. Let's address the common mistakes that cause friction. Treating the business casually, especially in early stages. Mixing personal and business decisions. And constantly optimizing payment routes, structures, or flows. These may seem minor internally, but to banks, they indicate loss of control. When operational discipline weakens, monitoring increases. And once monitoring increases, restrictions often follow. So what does a bankable structure look like? Defined roles, documented money flows, stable providers, predictable behavior. When these four elements are present, operational risk decreases significantly. And when operational risk decreases, friction decreases. That affects everything: banking, payment processing, tax interactions, and compliance reviews. Strong operations create quiet accounts. Quiet accounts stay open. Designed for stability, not just approval. If you want the full written guide on operational setup that keeps non-resident UK companies bankable, check the link in the description.
Are you looking to start selling online in the UK from your country? RTR Supports Limited offers hassle-free UK online seller account services for worldwide entrepreneurs. Our expert team guides every step to set up your Amazon seller accounts quickly and smoothly. We take care of everything for you, making your entry into the UK market smooth and successful. We guide you through every step so you can sell internationally with confidence. Start growing your business today. Services that we support: UK company formation, UK registered office address, UK phone number, UK bank account, Payoneer, Revolut, PayPal, etc. Most importantly, UK nominee director, that is UK local resident, and marketplace listing. Get your UK online seller account up and running today. Contact RTR Supports Limited for more details. Contact on WhatsApp number +44 7765 310446 and visit rtrsupportslimited.com. Thanks.
Subscribe to RTR Supports Limited for clear, structured guidance on UK banking, payments, and compliance strategy. Because in 2026, approval is temporary, operational strength is permanent.